studying your last two. I swim med tea when they turned in. The staring down to mute. And can learn the pole that sunk he died.
The reasonable return test is another important exception within the TOSI framework, but it approaches the problem from a different angle than the excluded business test. The excluded business test focuses primarily on active involvement and labor contributions. The reasonable return test, however, asks a broader question. Did the shareholder receive a return that is reasonable based on what they contributed to the business? Not every contribution to a business comes in the form of work. Some individuals contribute capital by investing money into the company. Others provide financial support through loan guarantees, assume business risk, contribute assets, or help fund growth and expansion. The reasonable return test recognizes that these contributions can have real economic value. A useful way to think about this rule is to compare what was contributed with what was received. If a shareholder invested significant capital, exposed themselves to financial risk, or provided meaningful support that helped the business succeed, it may be reasonable for that person to receive a return in the form of dividends. This is why the slide uses a balance scale. On one side is the shareholder's contribution. On the other side is the dividend received. The central question is whether those two sides are reasonably balanced. The analysis is not based on a fixed formula. There is no universal percentage or dollar amount that automatically qualifies as reasonable. Instead, the review depends on the facts and circumstances of the specific situation. Practitioners often examine the amount of capital invested, the level of financial risk assumed, the shareholder's involvement in the business, and the overall economic reality of the arrangement. The stronger the contribution, the stronger the argument that the dividend represents a reasonable return. Conversely, if very little was contributed and a large dividend is received, the CRA may question whether the return is justified. The key takeaway from this slide is that dividends are not evaluated in isolation. The reasonable return test looks at the relationship between contribution and reward. When a shareholder has provided meaningful capital, assumed genuine risk, or otherwise contributed value to the business, a dividend may be viewed as a reasonable return and may qualify for relief from the TOSI rules. One of the most challenging aspects of the reasonable return test is that there is no single formula that automatically determines whether a return is reasonable. Instead, the analysis requires a review of all the relevant facts and circumstances surrounding the shareholder's contribution and the dividend received. The starting point is usually capital contribution. Practitioners consider how much money, property, or other assets the shareholder invested in the business. Generally speaking, larger and more meaningful investments provide stronger support for a reasonable return. Another important factor is risk. Did the shareholder personally guarantee loans? Did they expose their own assets to potential loss? Did they assume financial risks that helped the business obtain financing or continue operating? The greater the risk undertaken, the stronger the argument that the shareholder deserves compensation for that risk. Labor contribution can also play a role. Even though this exception is often associated with capital, the analysis may still consider the time, effort, and involvement contributed by the individual. Someone who both invests capital and actively participates in the business may have an even stronger position. Skill and expertise are also relevant. A shareholder may contribute specialized knowledge, industry experience, strategic guidance, or professional expertise that helps the business grow and succeed. These contributions can have significant value even if they are not easily measured in dollars. Past contributions should not be ignored either. The history and consistency of a shareholder's involvement may provide important context. Contributions made over many years can be just as relevant as current involvement. The analysis also considers the circumstances of the business itself. Factors such as the size of the company, industry conditions, growth stage, and overall economic environment may influence what would be considered a reasonable return. Ultimately, the guiding question is simple. Would an independent person consider the return reasonable when compared to the shareholders' contributions? That question helps practitioners step back from the technical details and evaluate the overall fairness and economic reality of the arrangement. The key takeaway from this slide is that reasonableness is determined by examining the complete picture: capital, risk, labor, expertise, past involvement, and business circumstances all work together to help determine whether the return received is justified by what the shareholder contributed. The reasonable return test ultimately comes down to a simple but important question. Does the return received by the shareholder match the contribution that shareholder made to the business? This slide compares two very different situations. On the left side, we have an example of a potentially reasonable return. In this scenario, the shareholder has made meaningful contributions to the business. They may have invested significant capital, provided loan guarantees, assumed financial risk, or contributed resources that helped the business grow and succeed. As the business benefits from those contributions, the shareholder receives a dividend, because there is a clear connection between what was contributed and what was received. There may be a strong argument that the dividend represents a reasonable return. In this situation, relief from TOSI may be available. On the right side, we see a very different fact pattern. Here, the shareholder contributes little or no capital, assumes little or no risk, and has limited involvement in the business. Despite those minimal contributions, they receive a large dividend. This creates a potential problem. When the return is not supported by meaningful contributions, the CRA may question whether the dividend represents a reasonable return. The weaker the connection between contribution and reward, the greater the likelihood that the TOSI rules may become relevant. Notice that the analysis is not focused solely on the amount of the dividend. A large dividend is not automatically unreasonable, and a small dividend is not automatically reasonable. The key issue is whether the dividend is justified when compared to the shareholder's overall contribution. That is why the scale in the center of the slide is so important. It symbolizes the balancing exercise that practitioners perform when applying the reasonable return test. They are comparing what the shareholder contributed with what the shareholder received. This comparison requires judgment. There is no precise mathematical formula that determines the outcome in every situation. Instead, the analysis focuses on the facts, circumstances, and economic reality of the arrangement. The key takeaway from this slide is that the reasonable return test is fundamentally a comparison. The stronger the shareholder's contribution of capital, risk, labor, expertise, or other value, the stronger the argument that the dividend represents a reasonable return and may qualify for relief from the TOSI rules.